So I've had a lot of questions about how restaurant businesses are supposed to record their inventories and cost of goods sold. Most of my clients in the restaurant industry are quite confused on this issue. So I decided to get deeper into this concept and explain it in the simplest ways. So for those of you who don't know me yet, I am Andrew Molo. I am a CPA and a QuickBooks Pro advisor, managing owner of ARM Accounting. We are a small remote QuickBooks consulting company based in the Philippines, and we serve businesses abroad, mostly in the US. So without further ado, this is Restaurant Inventory Setup Explained. The debate on this issue is whether or not restaurants should be using the inventory tracking feature in QuickBooks Online to account for their inventory movements and cost of goods sold. I suggest that they shouldn't, but in order to give you guys the right context, allow me to show you first how inventories work inside QuickBooks Online. Every time you set up an inventory item or an inventory part, QuickBooks will require you to link that item to an asset account, an income account, and a cost of goods sold account, so that every time you make a purchase transaction, QuickBooks will increase the inventory asset account. Every time you make a sales transaction, QuickBooks will increase the income account, and it will also increase the cost of goods sold account. So here I have opened 3 ledger reports for our cost of goods sold account, our income account, and our inventory asset account, so that we'll be able to see what happens to these 3 accounts when we make a purchase transaction and a sales transaction. So just to give you guys a heads up, when we create a purchase transaction, if it's entered as a bill, that would be a debit to inventory asset and a credit to accounts payable. If it's entered as an expense or an outright expense, that would still be a debit to inventory asset and a credit to cash on hand or cash in bank. Now, when you create a sales transaction, there will be 2 entries involved. First is the debit to accounts receivable or cash, and then credit to the income account, which is an increase to income account, okay? And then the other entry is the adjustment of your cost of sales and inventory balance. So that would be a debit to cost of sales and a credit to inventory asset account. First, let's create a purchase transaction. So on the left navigation pane, go to expenses, and I'm going to enter this as an outright expense or an expense instead of a bill. So I'm going to go to this green button that says new transaction. I'm going to click on the drop down button beside that and choose expense. Now I'm going to go to the item detail. If you are going to enter an expense or a bill as an item, you go to this field. If you want that recorded directly to your ledger account, you use the category details, all right? So on the first row, I'm going to choose our test item. It's this one. We will be purchasing this at $20. And then let's hit on save and close. Now the transaction is recorded. We should be seeing a debit to the inventory asset account in the inventory asset ledger report. So it's this one. And I'm going to refresh this page. And there you go. Now we have an expense transaction, a purchase of a test item, and it's a debit to the inventory asset account at $20. Next, let's create a sales transaction. So on the left navigation pane, you go to sales, and I'm going to be entering this as a sales receipt instead of an invoice. So I'm going to go to all sales, and then on the button that says new transaction, I'm going to click on the drop down button beside that, and I'm going to choose sales receipt. Then we scroll down, and then I'm going to enter the test item. And let's say we will be selling this at $25 a piece. We have purchased this at $20 a piece. Now we're selling it at $25, okay? And it's tax-free. And I'm going to click on save and close. Now we should be seeing an increase in an income account, and that's the first entry. And the second entry would be an increase or a debit to cost of sales and a decrease to inventory asset account. All right, so let's look at the first entry. I'm gonna go ahead and refresh this page. So there it is, our sales transaction for $25. It's on the credit side. And let's take a look at our cost of goods sold. It should be on the debit side. So there you go, it's on the debit side for $20, which is the original purchase price. Okay, so the second entry is, which is this one, the second entry is a debit to cost of goods sold and a credit to inventory asset account. So when we go back to our inventory asset ledger report, it should show us a decrease or a credit amounting to $20, right? So I'm gonna go back to our inventory asset ledger report. I'm gonna refresh this, and then it's gonna show you a credit to $20, which makes the balance 0, and that's an indication that the item is already sold. So the beauty of this feature is that QuickBooks already creates the profit and loss for you in real time. So it already adjusts the cost of goods sold and the balance of ending inventory. You no longer have to go to the stores and conduct a physical count just so that you will arrive at correct balance of cost of goods sold. QuickBooks already does that for you, but it only applies when you are selling the exact same item that you purchased. In restaurant businesses, this is definitely not the case. Imagine purchasing ingredients such as tomatoes, onions, meat, garnishes, spices, and condiments, and then you are converting these items essentially into a final dish that you can sell. You would definitely have a hard time tracking the costs of these ingredients into the final dish using the method that I showed you inside QuickBooks Online. However, there is a feature in QuickBooks Online called Bundle. It's basically an item composed of multiple items. If you think about it, we can use this to track the cost of our ingredients into the final dish, but I seriously do not recommend it, and here is why. So here is how you create a bundle. So the bundle's name is Shrimp Ravioli, which is essentially our dish, and it is composed of multiple ingredient items such as shrimp, flour, we have eggs, salt and pepper, and butter. Now the problem with this is that, number one, you need to be extremely precise when it comes to your measurements. Since this also affects your operation, it will make your entire setup much more complicated than it should be. Number two, since this is already the setup that you should be following, in order for this to make sense, you have to enforce this into the kitchen. And then you will end up taking away the freedom of your kitchen staff, including the chef, to perform in the manner they see fit. They will be forced to measure everything that goes in and goes out of the kitchen, and then eventually your kitchen starts to look something like this.
Shrimp.
They're defrosting right now.
Head chef Daniel and the kitchen staff are unfortunately stuck in their same old habits.
What in the fuck is that? Cups and bags, cups and bags. I thought the only thing that went in bags were bodies.
So this is what I would recommend instead. Number one, when creating items for your ingredients, do not use inventory part. Use non-inventory parts instead. Now, when creating a non-inventory item, notice that there are two options right here. This one says, I sell this product or service to my customers. You have to uncheck this box and check the one that says, I purchased this product or service from a vendor. And then you have to link this item into an expense account, ideally a cost of goods sold account, okay? This setup will record all of your purchases into the cost of goods sold account. Now, in order to arrive at the correct balance of cost of goods sold at the end of the month, you should go to the stores and conduct a physical count, which means you will have to count everything that remains unused or unconsumed in the store. And then you assign costs to those items, and then after finalizing it and arriving at the final amount, you should adjust that into QuickBooks by entering a journal entry. And the entry should be a debit to inventory asset and a credit to cost of goods sold. Now, this will be a deduction against the beginning balance of cost of goods sold. We are essentially removing the portion of the cost of goods sold that is still unused. Now, the entry should be posted at the end of the current month and reversed and posted at the beginning of the following month, so that all of the costs of the remaining ending inventories should revert back into the beginning balance of cost of goods sold for the next month. For restaurants, this is probably one of the most practical ways to generate the correct profit and loss statement without messing up the processes in between. Remember that there is no need to sacrifice practicality for accuracy, because the more difficult your process is, the more inaccurate your reports become in the long run. So that's it. Thank you guys for watching. I hope you find this helpful, and please don't forget to like and subscribe, and I'll see you guys on the next video.